Hello and welcome to the Stansberry Investor Hour. I'm Dan Ferris. I'm the editor of Extreme Value and the Ferris Report, both published by Stansberry Research.
And I'm Corey McLaughlin, editor of the Stansberry Daily Digest. Today we talk with Pete Carmasino of Chaikin Analytics.
Pete, welcome to the show. Good to have you with us.
So glad to be here. Appreciate the invite and looking forward to this. This sounds like a lot of fun.
It is a lot of fun. It's a lot of fun for me. Me
too. Yeah, it's always nice for me too.
Yeah. We like what we do. We like talking to people like yourself. So this is your first appearance on the podcast.
Yes.
So I always like to start out with the same question. I start and end with the same question. I don't know where I got this idea from, but here it is. I'm committed to it now. And the question would be, like, if you and I kind of met in a bar and the subject of finance came up and you told me what you do and I told you what I do, I might ask you, what kind of investor are you? How would you describe yourself, as an investor?
Yeah. I get that question in a different format sometimes. But it's an interesting question because a lot of people ask me, hey, what's your favorite book? How can I learn what you've learned, or what kind of investor are you? And it's blood, sweat, and tears, over the course of many, many years. But for me, it's really about price, right? I mean, the price to me kind of says everything. So I'm very technical from that standpoint. And yet at the same time, fundamentals obviously matter, right? Because, we're in earnings season. So you can see that, yeah, price might be trending in one direction, but if your earnings aren't being delivered properly, the street will reprice you very quickly. So, the price will change rapidly. Yeah. So we saw, like a name that reported recently, like Palo Alto and things of that nature. So these stocks will get, well above their trading ranges where they belong. And that really kind of shows you some things as well. A lot of these were overbought. So price was already telling us that. It just depends on how long you want to stay in the game. So for me, I'm a trend follower, and I look for, the specifics of what I call the turning point, right? And it could be down or up, and we want to avoid the ones that are turning down, and obviously try to get involved with the ones that are turning up. So trend following is really the short answer that I just made very long.
Okay, no, I'm glad you made it longer, because trend follower, it's kind of a buzzword that gets thrown around, and we all assume we know what it means. But so how long how long is a typical trade on for you?
Yeah, that's a great question too. Again, it just depends. Sometimes, I'll give you an example. One of the trades I called out, I think it was December 21, heading into 22, was to be, to avoid bonds. Right now, you could have used that to be short bonds, and that trade lasted for a long time. Right, that was well over a year. But that's a long-term trend. Those trends can be in place for longer period of times. Another one could be the recent tech rally, right? Now, a lot of tech started to rally in October of 2022, and now we're starting to see the effects of, quintupling of share prices. At some point gets to a point where you have to start looking at relative strength. How is it performing versus the market? And that trade lasted for over a year. But the typical trade is not that long. It's 6 to 8 months, sometimes less, depending upon, again, the variables that come into play. Could be, for me, there are some not hard and fast rules, but some mental rules that kind of trigger once in a while. Let's say you have a stock that you're in, maybe you're up 10 or 12 or 20% on, and all of a sudden they have a great earnings report out of the blue and pop 20%. To me, that's the time to sort of either save it or say goodbye to it, right? And it feels like it's too much too fast sometimes. So sometimes I break a rule on the trend side, but that doesn't hurt me most of the time if you're taking a big profit in a short amount of time. But yeah, I think 6 to 8 months is a fair assessment of an average time frame.
Okay, and you trade all equities? I mean, yes, just equities.
Equity, ETFs, that might represent in, fixed income or things of that nature, but, they trade like stocks. It's amazing how, fixed income turned into equity, right? I mean, you can buy an
Yeah,
ETF that trades like a stock.
right.
And they're
All
not
kinds
supposed
of
to, remember, bonds are supposed to be the safe haven, right? They're not supposed to be volatile.
Yeah, all kinds of stuff turned into stocks, hasn't it? Via
Yeah,
ETFs.
Bitcoin.
And,
Yeah, exactly.
yeah,
Everything.
yeah, Bitcoin and derivatives and all kinds of things, and
Yeah,
buy right
derivatives, even
strategies.
commodities. There are tons of commodity ETFs that look, interesting, and some of those are starting to, you know, really trigger, more inflationary pricing as well on some of those hard commodities like wheat, sugarcane, soybeans, coffee, and cocoa. My gosh, cocoa's been through the roof in the last several months.
Yeah, I've seen that chart. It's pretty spectacular. I think we should probably sort of rush to where we always wind up anyway. Every time we talk to a trader um, who's been around the block, as you have, we always wind up talking about the most important thing is not how you enter a trade, but your risk controls, the position
Yeah.
sizing, cutting losses, et cetera, et cetera. So tell me how all that works for you.
Yeah, and I think it could be uh, really defined as discipline to
Mm,
a process,
yeah.
right? And that's what risk management is, and that's just like a lot of things in life, right? Sometimes it's moderation. You can certainly have a good wine, but too much good wine is probably no good, right? At some point, in one sitting, anyway.
Yeah.
And it's just like I just mentioned. You might be in a trade that's working really well, and all of a sudden you get this pop of 20-25% on earnings or something of that nature. I mean, to me, it's like, man, money in the bank, takes them off the table. So along the way, there are areas in the chart that kind of point out tactical moves. That could be tactical sells or tactical buys. If you're in a continuation of a trend and you've got a pullback for whatever reason, it could be, who knows, Jay Powell sneezed at the wrong time in one of his press conferences, and people took it as he's going to lower rates. Um, you know, that could be an opportunity to add to a position that's already working. But again, for me, it's about relative strength. And on the Chaikin charts, we have a nice indicator that's not the typical RSI. It's really a derivative of that Mark Chaikin created, and it really kind of shows the strength of a stock over a period of time versus the S&P. And so there were times, even in some of the Mag 7, I hate to use that term, but it is what it is. Some of those names had pulled back, but the relative strength didn't budge at all. And so those are great tactical times to add. At some times, you might see stocks break a long-term trend while relative strength is also breaking down. That's a really great time to either avoid the position or certainly not to get involved, and potentially even sell or trim your overall exposure. So yeah, the sell discipline changes with the environment. I always say that, people say, how do you know where to invest? Like, just tell me what the environment is. Tell me what the 10-year is. What are we looking at from rates and unemployment? You got to look at the economic, the external factors first to tell you, where you should be invested. And so I think that it all kind of encompasses the one word, which is process, and the second word would be discipline. So if you have a process, stick to it. That's it.
Related to
Process that
that, one
works.
of the things you wrote recently in the Chaikin Power feed, the free newsletter, which I would encourage anybody to check out if you don't already. Writing about like overbought, oversold, right? And
Yeah.
particularly like the middle of this month. Can you explain to people like just because something's overbought doesn't mean necessarily it won't go higher, and just because it's oversold doesn't mean it won't go lower? I mean, what are the
Yeah.
nuances there?
It's true. I always say Wall Street in general has created terms, a bunch of terms that mean the same thing, right? And just to confuse people and kind of get people, misunderstood. I don't know if it was intentional, but I think so many practitioners came in, a lot of cooks in the kitchen decided what to call things. They might say you should be underweighted or overweighted. Like, well, how do I know? What does that mean? What does that actually mean? It's like overbought and oversold. So overbought is tactical. Anytime you hear those terms, to me anyway, in my opinion, that's tactical. In other words, that's very short term. That could be a week to a month, right? It could be, deviate a little bit by a week or two on those two timeframes, but at some point, it really depends again on the environment. Now, when tech started to break down back in, let's say, 2022, beginning of 2022, it was really the first week of January, if I recall correctly,
Hmm.
and things were changing not so much rapidly, but people were in that buy the dip mentality, right? So they thought it was oversold. But if you look at the way it was sort of, to me, the way we saw it be, playing out from a relative strength standpoint, it was not a buy the dip. It was probably a hold and wait and see. And then obviously if the trend continued, you started to see, all right, we're starting to see one fall after another. That's your time to start. You have to have peripheral vision too, right? You can look at your one position straight on, but look at the peer group as well. And if they're all breaking down, something's changing. So that's another, great way to look, determine if it's oversold or a change in trend. That's two different things. But
Hmm.
as long as the trend is intact, oversold is really sometimes an awesome time to add to a position, add to your winners, right? They're supposed to do, and sell your losers, right?
Yeah, there's more to it than meets the eye. One
Yeah.
of the things that when I first met Mark and we started talking about his power gauge, one of the things that kind of shocked me a little bit was I just assumed, I heard about this power gauge system and I figured, oh, it's a technical system. And then he said, well, it's mostly fundamental indicators. And I was like, wow, really? I was amazed. I
Yeah.
was like, hey, a man after my own heart, And
Yeah.
but you sound like you're focused primarily on technicals. So
Yes.
so you sort of if the Chaikin world is this fundamental plus technical thing, you're strictly on the technical side. Do I have that right?
Well, not necessarily, right? I mean, the one kind of validates the other sometimes, and we'd
Mm.
love to be able to marry both together at the same time, which we often do in some of the names that we're looking at or calling out in our various newsletters, or even on that Shake and Power feed, the free newsletter. It's like having a really beautifully fast built sports car, right? The technical aspects there are fantastic, the engine running, the technical side, the price looks fantastic, but if you have the wrong tires on the car, you may not get to the destination as quickly and safely as you want it. But if you've got the car and the tires, you've got yourself, a pretty winning combination. And to me, the fundamentals keep the stock grounded and the trend intact. And so it's nice to see both. And sometimes, and counterintuitively, the technicals will precede the fundamentals. And what I mean by that is we might see stocks that have,
Yeah.
let's say, what by our standards, what we call our financial category, which is like price to sales, price to book, debt to equity, things of that nature, the way we weight it. That might be bearish on some of the names that we're looking at. And a lot of people go, wow, why, it's bearish, or, why would you want to be involved? Well, the chart's telling me something different. You do have to do a little bit of look back and some homework and say, all right, are things changing in the financials as well? And if that's the case, that becomes sort of the catalyst, right? So the technical side of the trade is alerting you, and then the fundamental is almost like the wind at your back at sometimes, that there's the catalyst, there's where the upgrades come, there's where Wall Street jumps on board. And the reverse is true, right? Sometimes the technicals, you're avoiding a stock. I'll give you a great example is Archer Daniels Midland, ADM, has been in a downtrend for the better part of a year. And they didn't have their worst day in 99 years when they were in an uptrend. They had it when they were in a downtrend. It was at the end of the trend. And that's when Wall Street started to downgrade it. But we weren't even looking at it because it was already in a downtrend. So when the fundamentals and technicals are intact together, man, it just increases confidence in what you're seeing on the charts.
Yeah, I've heard that. I won't say many times. I've heard it a few times over the years. The idea that the technicals will start turning before the fundamentals, which makes sense because at any given moment, the fundamentals are, minimum 2-3 months old, right? 1, 2, 3 months old.
Yeah,
Um,
it could be longer in some cases, and that's really,
that's right. Yeah.
it's that rear view mirror. But I think it can become the catalyst. And I always say that fundamentals tell you what to look at, right? Technicals tell you when, and the why will come out later, right? Why is it changing trend? Why are the fundamentals weak and getting better? I don't know why, right? Sometimes it takes a month or two before the why reveals itself. Now, great fundamental researchers like yourself and other folks here at Stansberry can kind of find trends in those numbers. For me, it's the price that kind of sort of dictates the action, and the directional change or trade that you want to take.
So what are you looking at really short term here from the price action in, as we speak here, middle of February? A lot of people, I don't know. We've seen this. We keep seeing the same the Mag 7, Mag 6, whatever you want to call them. Same story,
Yeah.
kind of as last year, minus Tesla. I mean, and I don't know. People are waiting for. I think some people are anticipating some sort of pullback or an end to this, but hasn't happened yet. I mean, what are you looking at right now?
Yeah, I mean, I think I'm always looking at a lot of. Somebody just asked me this question a couple of days ago. Do I have a specific sector that I focus on? That's not really. I mean, I'm looking at sectors to kind of tell me what I should be looking at from an individual stock basis, right? So we top-down analysis, look at the sector rotation and see what's going on. I was just on a call where I was talking about offense versus defense, right? The three offense sectors are technology, discretionary, and communications, right? Very tech heavy, right? Discretionary itself, I think, is 50% Tesla and Amazon or something, right? And that those have sort of dictated where the market goes. It gets a concentrated position in the top 7 names, like you mentioned, and then all of a sudden the indexes are off to the races. And so I try to find and I try to look at both the offensive sectors, which is again tech, discretionary, and communications, versus the defensives, which are utilities, staples, and healthcare. The 3 main ones. Now, people could look at subsectors, and you can dissect this into many, many parts.
Right.
But in general, when you're seeing, you can look at value over growth. It's the same chart almost. You're just seeing that the defensives just aren't they're just not on the field, right? Offense still has the ball currently, but they're just not moving it down the field very quickly, right? So it looks to me like we're probably getting, we're overbought from a bullish percent standpoint, which is kind of one of the indicators I look at. But a lot of things were telling us that it wasn't just one indicator. And I think when you see multiple ones, you start to see, all right, well, this could be a time to, take the foot off the gas a little bit, tap the brakes, and look for that opportunity to enter either a name you've been watching or waiting for, or one that's just, has such a high movement to the upside. You just mentally, you can't get there to buy a stock that's just, I think there's one stock that almost tripled in less than a month, right? And I think it went from like $400 to $1,000 or something like that. This is crazy, right? You can't chase those things. If you're not in them to begin with, you can't chase them. So the environment is changing slowly, but rapidly on individual names.
Our colleague Greg Diamond was on recently, also a technical trader, but he uses a particular way of looking at markets, which emphasizes price and time, price over time.
Yep.
And he named dates that he said would be important, like several weeks in advance. And he said February the 14th would be important. And I noticed that for now it's Nvidia's high closing price. And Nvidia has charged ahead, and it's led the Mag 7. It's the big one, right?
Yep.
And if you look at semiconductors, same thing. I mean, semiconductors to me look like 1999 right now. It's just
don't even say it. I'm having flashbacks.
Yeah. So does your outlook and the way you look at things, you mentioned looking for turns when we first started talking, like, and you guys look at fundamentals too. So how far do you go with this? Are you just looking to make trades and that's absolutely it? or do you actually develop a medium-term bearish view or a medium-term bullish view? Do you have an idea of longer cycles, like bull and bear market cycles?
Sure.
How far do you go
That's a
with
great
that?
question.
Yeah.
Yeah, I think we and Mark has probably you know trained me on this as well, not to be too bullish or too bearish at any given time, right? And it's about the environment and waiting until, because let's say in a bearish market there were ideas that, again, bearish based on what, right? Based on interest rates. Okay, well, what's going to be most affected by interest rates? Well, tech. So we talked about that for I can't remember how, it's been 18 months. I think I've been talking about it, maybe longer, about the interest rate cycle and how things kind of play out there. And I got my start on the fixed income side of the business, thankfully. So I kind of pay attention to rates and bond prices and the dollar and things of that nature. And so in a pullback inside of a bullish kind of environment, it's not necessarily bearish, right? It's more or less a cooling off period, right? So where you get these big runs like we've had, and I just did a short video just a few days ago where I said the Mag 7's turning into the Fantastic Five, right? Because two of them are breaking trend on the downside, and that was Apple and Tesla. And not only from the technical standpoint, but our power gauge, we're downgrading them as well. I think Tesla's bearish on our power gauge right now, and Apple's, I think, a neutral or neutral plus. And all that means is that the trends have changed and the outlook has changed. So for those two specific names, they're really kind of in a void at this point. And the other ones in that, again, that complex of the Magnificent Seven, look pretty strong right now. Right now. So you just had Amazon is being added to the Dow. They made that announcement, the day that we're recording here. But that's pretty interesting to me. And the only reason that they're getting added is because Walmart split 3-for-1, right? Because it's a price weighted index. And Amazon was already in a strong trend. And that trend hasn't really budged since it started, which was, for the better part of a year now. It's almost doubled since that trend started to the upside. And again, that was technical first, and the fundamentals caught up to the technicals. But I will tell you this, to Mark's credit, the way he created this power gauge, and I'd say this happens at least, for a better part of the names I look at, the fundamentals are turning prior to the technicals, which is really interesting to me. So that's what's really funny to me when I find a name that's changing trend. I go, man, the power gauge beat me to it sometimes. But there are instances where we're ahead on the technical side, and then the power gauge catches up. So it's really, it's nice to have that outlook from the fundamental side and the technical side. But yeah, being short term bullish or bearish is, I think, just tactical is the best way to say it. The strategy is always to find the names that are moving higher, no matter the environment. And if there's an outside catalyst that's pushing a group to the downside, you need to be aware of it. And if it's interest rates or the dollar or whatever the case may be, or oil prices or whatever, if you're missing that external force in your process, I think you're making a mistake.
Jerome Powell sneezing, or closing the door on climate protesters, or whatever it may be. Yeah.
It's incredible. Some of the press releases are just, whew, man, I don't know how he does it, but
yeah, you mentioned Mark a couple of times, Mark Chaikin.
Yeah.
And every time I hear him talk, I learn something about the markets, like something, multiple things usually.
Oh yeah.
How did you get connected with him whenever you did, and what's it like working with him on a daily basis so closely?
Amazing. Yeah, it's a grean story. So someone kind of told me that Chaikin Analytics was in Philadelphia, and then Mark was doing some interesting things and looking at an ETF rating and things of that nature. And that's kind of where my focus was when I was a registered investment advisor. Sometimes I'm not licensed anymore, but when I had that firm, I was an ETF expert, right? I put those portfolios together. And so when I heard that he was putting a rating together, we kind of got together, we talked a little bit, and what was meant to be maybe a half an hour meeting, I think turned into like 2.5 hours. And it was really, we kind of just hit it off. We were talking about our history in the market, what he saw over his years and what I saw we overlapped many years in the business, and so we shared a lot of war stories and really very similar experiences in the outcome of talking to institutions. Right, Mark basically built his sort of the thesis of the power gauge based on what he learned by talking to institutions, ironically, about technicals. Right. So, but he said, well, they're looking at all these fundamentals. So he wanted to combine the two. That's where the idea came from. But when we got into that, we always talked about the technical side. And when he told me about the ETF rating that was coming out, we were both like, yeah, this is probably a good fit. And we hit it off right away. It was kind of fun from the start. So
Yeah, and that had to be way ahead of most people's times in terms of putting ratings on. It sounds very common now, but back then was not, right?
yeah, I think and the cool part about the rating, and again, let's look at it from the standpoint of the ETF. Um, an U.S. equity ETF has a component of U.S. equities inside of it, so it's really just a portfolio, right? But it's a sector based or concentrated portfolio. And the cool thing about the ETF rating is it looks inside the ETF and weights the cumulative rating of the stocks inside the ETF. So now you've got a fundamental look at the whole portfolio with a technical overlay on top. I will say the technicals kind of outweigh the fundamentals in this case because the ETFs, are trending and very, they're passive investments that constantly get money added to them on a monthly basis. So the technicals kind of play a part in the trend of the rating, but it's a really cool way to really dissect an ETF. That's what helps us in finding ideas, right? Once we start to see changes in trends from the ETF standpoint, we can dive into the ETF and then see what's going on underneath the hood, as we like to say all the time.
Yeah, Dan, this is like another example. We've talked about the power gauge before and just the different things you could do with it. And we talked about it with Mark too. And so it's just more of that. This is more explanation of that.
Yeah.
Yes. So
absolutely.
I have a, it's almost over the years, it's become a programmed suite of questions about systems. And one of the ones I learned to ask about 20 years ago, gosh, more than that now, 25, 26. Yeah. Oof, scary.
Time flies.
So I've been through this experience where people say, discipline, adhere to the system, follow the rules, and honor the signals, basically. And then 5 minutes later, that individual will say, well, we didn't do this signal because, we're not going to do that. So, so then when somebody says there's no discretion, I'm like, yeah, sure. Let's talk for another 10 minutes and then I'll reveal to you how much discretion you have. So how much discretion are we talking about here? In the power gauge and your own trading and,
That's what's great about the power gauge, right? It's been locked up from the beginning. So no one changes the power gauge at all. Right? So the power gauge is set,
but
and
you get the question though, right? I mean, the power gauge, I'm not saying the power gauge changes. I'm asking you about what you do with the signals. Okay.
Exactly. So
yes.
the nice part is if as the signals come in, right, they're basically, for me, there are a multitude of things, but the really the king signal is relative strength, right? And so when if that's not signaling or triggering, I don't even look at it, right? So it's more or less, sure, I can put it on a watch list, I can put it on a wait and see list, that kind of thing, but I'm not wasting time until I start to see the trends change. Now, here's probably the discretion from the signal. So when you start to see a group of names, let's just say any sector, semiconductors, whatever you want to call it, paper makers, whatever, right? And software is a good example. You start to see a specific piece of the software complex starting to change trend. One or two laggards haven't changed yet. Those are probably ideas that you could maybe act on a little sooner, but that you're doing it, right? That you're probably taking the risk there to get a better gain because the price hasn't moved, rather than taking the actual signal on the stocks that are trending higher. You might still get a nice gain, but it may not be as good. So I think it comes from the greed side of the fence of you're trying to outsmart the signal by maybe doing it slightly early.
Exactly.
And sometimes it works out. Sometimes it works out. So there it is.
Sometimes it works out. Yes.
Right.
That's right.
It's,
but look,
yeah.
I mean, we talk about a lot of things, in the markets, and for me, we've always said that I follow the interest rate market, I follow the bond prices, we follow the dollar, and a lot of that is what's weighing on stocks one way or another, whether it's borrowing costs, whatever the case may be. You see the trends change when those external factors start to change, and so I think it comes down to the process and all of that, but I call it like autopilot, right? At some point, the pilot takes the control. You don't autopilot land and take off, right? You gotta take the stick. And I think sometimes the process might be too automated at some times, but you still need a pilot to jump in and get control of the plane sometimes.
I know you might not necessarily want to give away all your best picks or whatever. You have subscribers to think about, but what can you tell me about right now about what you like and don't like, or maybe are avoiding or not avoiding? Or
yeah, again, I think what we're seeing is, and to use a sort of a jargon term, sort of a blow off top, right? We start to see some of these names run in, and then guidance changes a little bit, but it's not like there's not growth behind some of these names. It's just not the expected growth that the market wanted to see, and I think it gets too quick, too fast, right? I've said that a couple times already today, but I think at the same time, again, for me, it's about rates, and I think I'm watching the unemployment rate, and to me, if I look back and I had an overlay of a chart of the Fed funds rate and the unemployment rate, the Fed doesn't really cut rates until unemployment starts to move higher. At what level, I don't know. Or I wish I knew. I wish I could say, at 4.6%, this is going to happen on unemployment. I don't know. I don't think anybody does. But when they say they're data dependent, I think that's part of the data. Actually, I know it is. So if you look back at the chart doesn't lie to you. Every time the unemployment rate started to move higher, Fed cut rates. Now, somebody says, well, how do you predict the unemployment rate? Well, I don't know. There's maybe one or two other indicators out there, like the ISM PMI, right? Purchasing Managers Index. And I think that is a really good predictor of the unemployment rate. So one begets the other. In other words, if the PMI starts to get to a certain level, say 45 or so, you might see an uptick in unemployment, which then could trigger the Fed. So at that point, things might change initially. And I haven't done a deep dive into this, but we all know this. This isn't a secret, that when the Fed's cutting rates, it's not for good reasons. It's typically something wrong. And so the market, I think, takes the gut punch when that happens. They take a knee-jerk reaction to the downside, potentially sideways action, and start to look forward and see who's really supplying them, again, to your point, with good fundamentals, good cash flow. The fundamentals, I think, become very important at that stage. And then I think it's technical time after that. So when rates, if they even get cut, they're going to be cut for some reasons that don't look good from the economic standpoint. So the economy could be slowing down at whatever measure or speed it could be. And at that point, the market pulls in a little bit, absorbs the punches, and then starts to reassess some of the names that might just be all fluff or all talk, or are they actually delivering earnings, cash flow, and potentially even better profits going forward. I think that's where you're going to see the second stage of what I would think is the continuation of the bullish trend. And so when is that going to happen? I don't know. I wish I did, but it seems to me that it should happen pretty soon.
Okay, fair enough. Let me ask the question from a different perspective. And if the answer is no, that's perfectly fine. I totally understand. You got any names for me? Or
when I look at I just said we talked about the ETF ratings, and we look from a top-down setup. So when I look at either the sectors, they're pretty broad. There's only 11 of them. You're kind of stuck with what you have. So I like to look at the subsectors, right? There are a set of subsector ETFs that we track as well, and our top three or four, I'll give you our top four right now, actually top five, are the number one subsector is insurance. The number two subsector is home builders. The next one is innovative tech. There's a lot of cybersecurity and semiconductor names in there. So that's one that's kind of like, maybe potentially stalling right now, but not changing. The next one is just your typical technology name, a lot of overlap in those two. And the last one is software. And so from that standpoint, there are two maybe more solid sectors that most people could rely on, like insurance and home builders, and maybe ones that are a little bit more growth oriented, like the tech and software subsectors. But inside of those, a name we talked about back in December, like Travelers, from the insurance standpoint, has done extremely well, and I think continues to. So property and casualty names like Travelers or W.R. Berkley, those are they look excellent right now, and look like they're continuing on the trends. And then if we do see rates start to pull in a little bit, it looks like home builders might be anticipating that, right? They've been on a tear, even in the changing in the trend, from where technology took off in 23, like a name like Toll Brothers wasn't far behind some of these names, right? You got D.H. Horton that looks pretty good, and some other names here that that could be pushed higher, or the catalyst could be lower rates for their top line revenue growth. So I think insurance, I think home builders are maybe the ones that people aren't thinking about right now. But obviously from the tech sector and software sector, there's plenty of names in that group that I think a lot of people can kind of take advantage of, but none that right now look like they feel like the right tactical time. So that's the best way I can answer that.
Fair enough. No, great answer. Great answer. And we've actually come
great.
to our final question, which is the same for every guest, no matter what the topic, even non-financial guests, same question. And if you've already said the answer, by all means, feel free to repeat it. And the question is simply, if you could leave our listeners with a single thought today, what might that be?
People ultimately ask you, what do you do for a living? And it comes up, we talk about finance and things like that, and not without getting into any advice giving, which we don't do. But somebody always says to me, how do you invest in the market when it's so high? And I said, well, the answer to that is to never not be invested over time. And I think that's really the key, is to eliminate FOMO. You already have to be there. So you're never going to miss out if you're invested over the long term, but you should have buckets of money. Long-term money that you're not touching, medium-term money that's maybe a little bit more liquid, but maybe a little safer, and then obviously shorter-term money for whatever else may come up. But I think is to avoid FOMO is to never not be there, right? So be invested over a long period of time, dollar cost average, whatever the case may be, whatever makes you feel mentally good. But you should never have to worry about the markets at the highs. That means you didn't invest at all, if you're worried about that, to me.
Great answer. Thanks for being here, Pete. I really appreciate it. It was really a lot of fun talking with you.
It was a lot of fun. Yeah, this is great. I appreciate it. I hope I did okay for you guys.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.